Chapter 5: Cost Estimation. Cost estimation is a concept that we use to try to predict costs in future periods. Since the periods haven't happened yet, then we have to use one or several cost estimation techniques to try to predict what those costs are going to be. This chapter, we're going to look at several of the different types of cost estimation techniques we can use. Why do we estimate costs? Remember that in chapters 3 and 4 that good decisions require good information about costs. Cost estimates are an important element in helping managers make decisions that add value to the company. And to be able to make good decisions, we have to have a good game plan. We have to predict what our revenues and costs are going to be in the future and act accordingly. As you know, costs can generally be categorized as either fixed costs or variable costs. Fixed costs means that the total amount of that cost is fixed, and variable cost means that the total amount of that cost is variable. Remember that the per unit variable cost remains the same, but the total cost will be different because depending on how many units are bought or produced, the total amount of variable cost will change. We're going to look at 3 different methods of estimating costs. We're going to look at engineering estimates, account analysis, and statistical methods. The first method is the engineering method. The book gives an example of this type of method by being used to estimate the cost of a new renovation center. So if you have an existing building and you're trying to renovate it, you're going to look at things like the size of the center. Depending on the size, you're going to look at how many labor hours are needed to renovate the center. Then you're going to look at the type of space, the type of activities that are going to be performed in the spaces. Like you're going to need space for office and administrative work. You're going to have to estimate what type of utilities you need, electrical, plumbing, and so forth. What type of permits you're going to need for the renovation. And so you try to predict every cost that you can think of that's relevant, and you add it all in to create this estimate. You look at all the different details, you compare it to other similar types of work in the market, try to find out what the market rate is, and create a cost estimate from there. So this is the type of estimate that's generally used by, let's say, someone like a plumber or a carpenter, someone who's going to do remodeling on your home or a commercial building. They're probably going to use some sort of engineering estimate. They don't call it that, they just call it a quote or a bid, but that's basically what it is. Engineering estimates can be a good thing. They require you to look at each step in detail, and you can also compare it to other similar projects in the market. And also you can prepare this estimate from scratch, meaning that you don't have to have existing data to try to come up with an estimate. You use market data. Some of the disadvantages, however, is that it can be expensive to use. Trying to come up with a very accurate type of estimate without previous data can be very time-consuming and costly if you hire someone to do the estimate. And it's also usually based on optimal conditions. So in case labor isn't as efficient as you thought it would be, or materials goes up, a lot of times these types of engineering estimates don't account for changes in conditions. And as you'll see, every method has its advantages and disadvantages. Another method of estimation is the account analysis method. And in this method, we do have existing data, and so we try to drill down into these accounts so that perhaps we can categorize these expenses more accurately into fixed cost and variable cost, and we can take that data and use it to help estimate costs in the future. Here's an example of an overhead account. The overhead account for 720 labor hours originally just showed a total of $43,788 in overhead. And so since we're doing this account analysis, what we did is we broke out all the costs under overhead. So we broke it out into office rent, utilities, admin support, supplies, licenses and permits, and other. So now we have more detail. And then we broke out the different expense lines into variable and fixed costs. And so this can be more useful than just giving a total number of $43,788. Now we know that 22,000 of that were variable costs and 21,000 of that was fixed costs. And so we'll see this 21,756 on the next slide. We'll also see the variable cost of 22,032, and we're going to divide that by 720 labor hours. 22,032 divided by 720, and that's going to give us $30.60 per labor hour. So now that we have our fixed cost and our variable cost per unit, we can plug in those numbers into our formula that we've used over the last several chapters. Remember that our total costs given to us was $43,788. We were able to plug in the total fixed cost of $21,756, and then dividing the total variable costs by the number of labor hours gave us $30.60. So we can check our work. 3060 times 720 repair hours plus the fixed cost of $21,756 gives us the total of $43,788. And now that we have our fixed cost amount and our variable cost per unit, we can estimate costs at different levels of repair hours. So here it's saying that if we were doing a job that required 960 repair hours, then we just plug in 960 here in the formula, multiply that by the $30.60 variable cost per unit, add it to the fixed cost, $21,756, and so our total cost would be estimated at $51,132. So we just break down the numbers into the components that we need, and then we can plug in the numbers accordingly into the formula. This type of analysis also has its advantages and disadvantages. One advantage is that managers and accountants are familiar with the company's operations, and so they're able to take an account like the overhead account and more easily break it into the different components and break it into fixed costs versus variable costs. But that same familiarity that the managers and accountants have with the accounts can also be a disadvantage. An accountant that might be trying to keep their cost estimate down might take a certain expense that's a variable expense, which is a recurring expense per item, and they might say, well, I really think it's a fixed cost, so I'm going to put it under the fixed cost column, and it's only going to be charged one time per month, when in reality it's charged more often. So we always have to be wary about personal judgment and bias when calculating these methods, especially because often these decisions have major economic consequences for these same managers and accountants. Oftentimes, a manager's bonus is based on if the manager is able to hit their budgeted numbers or exceed their budgeted numbers. And so a manager might be prone to creating an artificially low budget by manipulating the numbers, and then that way he can hit his benchmarks a lot easier. Or maybe he might try to overestimate costs, and then when the real numbers come in, he can try to claim credit for keeping the costs down when they were supposed to be at that level in the first place. Another method of estimation is using statistics and graphs. This slide shows us 15 months of production. It gives us amounts for overhead per month, labor hours, and material costs. So we can take this data and plug it into a graph. So this graph includes overhead costs and labor hours. And so for every month, they looked at the number of labor hours on the x-axis, and they looked at the relative amount of overhead costs, and they plotted the point on the graph. And so there should be 15 points on this graph since there were 15 months on the prior chart. And as we can see, it generally goes in an upward slope. It's not an exact slope, but the general trend is as labor hours increase, total overhead costs increase as well, which is what we would expect it to do. And so using the eyeball judgment technique, we draw a line through the points. And so we draw the line as best we can to fit through all the points. Now, ideally, there would be an equal number of points on the top of the line and then an equal number on the bottom of the line. But that's just one thing to eyeball whenever trying to draw this line. It's really not a super exact way to do a regression analysis, but it can still be very helpful. So one of the easiest things to tell from a graph like this is what fixed cost would be. So remember, costs rise the more labor hours are incurred, but at 0, we're still incurring costs. And it looks like it's roughly around 20,000. It's not going to be exact, but for our purposes, we don't really need it to be exact at this time. So for total overhead costs, we're going to start with 20,000, and then as we increase our labor hours, we're going to incur more costs. Another method is the high-low method, and this is going to be a method that we're going to use in our homework. The high-low method is just a simplified way of doing the previous graph, but instead of plotting 15 points, we're basically plotting 2 points, the highest point and the lowest point, and then drawing a line. If you remember from your math class, slope equals y over x. And for our purposes, slope is used to calculate variable cost. So here we're going to see that the month with the highest overhead costs, they incurred $55,581. The lowest month was $35,612. And so the difference between the two is $19,969. We're going to do the same thing with labor hours. The highest number of hours was 1136 in that same month. The lowest was 400, and so the difference was 736. So we're going to take this formula, which basically says the difference between the overhead cost minus the difference between the labor hours is going to give us our variable cost. And then to find fixed cost, now that we know our variable cost, we can just take that amount, multiply it by either the highest activity level to get total cost at highest activity level, or we multiply it by the lowest activity level to get the total cost at the lowest activity level. And once we have total cost and variable cost, we can find fixed cost. So again, let's remember these two numbers, $19,969 and 736 labor hours. And we look at this slide, the math that we calculated. Remember, we subtracted the highest overhead cost minus the lowest overhead cost, and we got 19,969. In those two same months, we took the highest labor hours minus the lowest labor hours and got 736. So our figure is $27.13 per labor hour. And so we just take the highest month. The total cost was $55,581. We calculate how much of that was variable, and we do that by doing 2713 times 1136 labor hours. We subtract that from the total, so we get fixed cost of $24,761. Now we don't have to do the same math for the lowest level, but we can just to check our work. So at the lowest level, total cost was $35,612. We subtract out the variable cost portion, which is $27,13 times 400 labor hours, and we also get $24,760. There's a little bit of a rounding difference, but for our purposes, it's the same number. And so now that we have fixed cost, remember, fixed costs is not going to change no matter if we do 1 labor hour or 1,000. And so we can use that figure and plug it into our handy formula. Total cost equals fixed cost plus variable cost. And so if we want to figure out what our total cost is going to be at 960 repair hours, we do the 960 times the 2713, add that to our fixed cost, and we get total cost of $50,806. The book also mentions regression analysis. That's just a fancy term for what we did with the scatter graph. We plotted the points and drew a line that best fit through those scatter points. Now remember, we did the eyeball method, so we just drew the line as best as we could and tried to make roughly the same number of points above the line as below the line. But there's actually a more accurate way to do that. You can either plug in those points in a graphing calculator or in Excel, and it'll draw you a very accurate line. You don't need to know how to do that in this class, but just be aware of it, and you'll probably see it in your finance class or your economics class in the future. The formula for the regression analysis is y equals a plus bx. So that's going to be similar to what you've seen in the past. What you've probably seen is y equals mx plus b. But that's the same formula. It's just that they switched the position, and instead of calling the y-intercept b, they're calling it a. But the concept is the same thing. Another concept in the chapter is the learning curve or the learning phenomenon. That means that variable costs tend to decrease per unit as the volume of activity increases. So the more you do something, the better you get at it, and the more efficient you get at it. Up to a certain point, of course, but especially in the beginning, the more you do of something, the better and quicker you get at it. So if you look at this chart, whatever they're producing, the first unit took 100 hours. The second unit was only 80 hours. The fourth unit was 64, and the eighth unit was 51.2 hours. Now in the real world, it doesn't always happen this smoothly, but the concept is a good concept. And as you can see, the more units you produce, the more efficient you get, but that efficiency starts slowing down. So the second unit only took 80% of the time of the first, but then it took 4 units to get that same amount of improvement, that same percentage of improvement. And then it took 8 units to get to that same level of improvement. So improvement is slowing down. It's taking more and more units to produce to achieve the same percentage of decrease. But it illustrates that it's a curve. So for the first few units, you're going to drop pretty quickly. And then as you create more units, you're still going to get more efficiency, but at some point, it's going to start leveling off. And finally, the last slide, it shows us different cost estimate methods we can use. We've talked about the account analysis method, high-low, simple regression. We didn't talk about multiple regression. That's if we have more than one variable, but it's beyond the scope of this course. As you can see, the methods have slightly different results. Using the account analysis method, we got an estimate of $30.60 per labor hour. The high-low method gave us $27.13, and the regression gave us 3463. So the recommendation is usually to do more than one method of cost estimate if you can. Each firm and each project is going to be constrained by time and cost, but you try to find a balance. You try to see what information and what methods you can use within an allotted amount of time and budget to come up with the best estimate you can. So that's the end of the Chapter 5 lecture. Now on to the homework.